What is up, YouTube? Welcome into the webinar event of the quarter with the Everyday Growth Advisors. I hope that you guys are having a good start to your week and your weekend. If you can hear me, give me a quick thumbs up in the chat very quickly to let me know that the sound is working okay and that you can see me. Welcome into this webinar event. I'm really excited for this big event because we are going to uncover a lot of things about the market, and I'm excited to share everything with you. Just before we start, I want to definitely get through some housekeeping. So very quickly, if you can hear me, you can see me, just tell me you can hear me and see me in the chat, and that way we can continue with the webinar. Excellent, that's great. Thank you so much. Welcome in. This is the live webinar for the 2023 market update. I am Tushal Sharma, the founder of Everyday Growth Advisors, and I will be guiding you through this session today. So let's get started because we have a lot to unpack. But right before we get started, I just want to kind of cover a little bit about why you should even know or hear from me, right? Who am I and what can I bring to the table? What kind of value can I deliver for you? And more importantly, what are you going to get out of this webinar that's going to help you on your journey towards trading success or investing success? So a little bit about me. I'm the CEO and founder of Everyday Growth Advisors, and I've been investing and trading for about 10 years. I've survived one financial crash to the 2008 financial crisis, and I recently graduated with honors in Masters in Finance in 2021. Many of you who've been following EGA for a long while, you've been through that journey with me, seeing me go through my entire Masters, and I really do appreciate your support. I currently manage about a $1.7 million hybrid portfolio, which has both stocks and I trade options as well. And my 2022 P&L was about exactly 1 million, and I'm hoping to beat that this year. Now, how do I get that success and how do I be consistent in my trading career? I'm about to uncover some of those things in today's webinar. And more importantly, the people on Discord and the people who have taken EGA version 3.0, if you are in the chat right now, I'm sure that you can vouch for EGA and all that we do. So just a little bit more about my portfolio and the way that things have been working. My average profit and loss for the past 5 years have been well above the benchmark S&P 500, and I use my own personal style of value and momentum investing. Okay, so let's dive straight into the agenda for today. Now, today's agenda is going to be a mix of different things, and forgive me because my head is going to bobble all around the screen today, but you know what? It's going to be good. So we're going to start off with bond markets, and this is going to be a big topic of the day. Many of you might be very anxious to learn about the bond market because you don't know much about it. Every time you hear about yield curves and you hear about bonds and you hear about the 20-year or the right tail or the left tail or all those things that people talk about in the professional world of finance, many of you might not know what that is. And I'm here to simplify that for you. I'm here to make it easy for you to understand. And more importantly, I'm here to help you relate that back to equities so that you understand what you're investing in. Right after that, we're going to get into the Fed and the balance sheet. Okay, the balance that they have to create in the economy and monetary policy and money supply. How does the Fed balance monetary policy? Then we'll jump into the 2023 market update, where I'm going to recap 2022 and also go through secular trends for this year and also some of my best stock picks for this year. Then we'll look at what to buy in 2023. And finally, we'll end this webinar with mastering the psychology of markets. I'm going to go through some of the most blaring mistakes that traders make and how do you avoid them. Some of the most important things that has helped me in the past 10 years of my journey. Make sure that you stay till the end because only attendees of this webinar will be privy to a special announcement and coupon code for the courses that we offer. So I highly recommend you stay till the end so that you can take advantage of it and at least know what the coupon code is so that you can apply it at the checkout if you do choose to join EGA. And we'll talk about EGA and what we offer at the end of this webinar. So let's jump straight into it. So let's go through bonds first. Now, what are bonds? And if you have always thought about bonds, you always might be confused. Like, what are these things? Like, who even deals with them? Or, is it even worth to know about them? Well, here's what you need to know. The bond market is a pretty big market. And in fact, it is the biggest market, even bigger than the equity market. Okay. And there are three main institutions that issue bonds. The first institution is going to be the Federal Reserve. Okay. And the Federal Reserve is the main institution that issues bonds. Their main goal is to create a sense of credit for the market, and that's where money supply comes from. Okay, so all the money that you use on a day-to-day basis and money that is borrowed by banks, that is lent out to customers, is all born in the Federal Reserve. Okay, and these are typically called debt instruments. Okay, debt instruments, that's what we call them. And when we talk about the bonds that are issued from the federal government, these are typically called treasuries. Now, they have different names that go along with them. Sometimes they're called notes, sometimes they're called bills, and sometimes they're called bonds. Okay, they are all used synonymous based on the maturity, the time horizon of the security. So investors, they lend the money to the U.S. government to carry out its business in return for an interest rate payment over time, depending on the horizon of the bond. Okay, so sometimes you might be somebody who wants to lend money to the government for only 1 month, then it attracts a certain amount of interest. Or you might want to lend the money to the government for a longer period of time, like the 10-year, which is the most common and the most famous bond that is invested in. And that will be for a period of 10 years, and that will attract a certain interest. And then maybe you're a long-term bond holder, and you want to lend the money to the U.S. government for 30 years. And that's the maximum that you can go in terms of the lending period to the U.S. government. And that attracts a certain interest rate as well. Okay. The second people that can issue bonds are corporations, right? Businesses of corporate America. And they carry a higher risk to reward. Why? Obviously, because if you're not the Federal Reserve, anybody else who borrows you lend money to pretty much will have a higher risk, right? So these bonds are rated by credit agencies. You might have heard of Moody's or S&P Global and all of these other rating agencies. Even Bloomberg does rating now, right? And they typically have ratings that are associated with the bonds based on the credit worthiness of the businesses or the corporations that are involved. So triple A's are considered the highest of these bonds in terms of quality. That means they're the most stable, they're the most investor worthy. And then the worst ones are called junk bonds, right? And if you remember from the movie The Big Short, right? You guys remember where there were a whole bunch of bonds that they put together. What caused the entire debacle with the financial crisis in 2008? It was a whole bunch of triple C's and double B's and triple B's that were put together, and then they packaged them and then they sold them to people. I don't know if you know what I'm talking about, but during The Big Short, they kind of explained that. Those were the bonds that people were kind of betting on, right? It's the same exact bonds, the corporate bonds, okay? Now, investors, they can lend the corporations money to carry out their operations in return for a fixed or variable interest rate as well. Okay, so there is the Fed, there is corporations, and then the third person is the state governments, or we call them munis, right? Municipal governments. So these are called municipal bonds and also called munis. They help the states pay for capital expenditures, which are also called capex. And typically this is to fund roads, bridges, schools, markets, water pathways, parks, things like that, right? And interest on these munis are typically tax-free, okay? That makes them an attractive investment for the rich to park their money while receiving interest, okay? So this is the basics that you need to know about where bonds come from. Where are the birthplaces? They can pretty much be one of these three places, okay? So how big exactly is the bond market? Well, the funny thing is, many people don't know this, but the bond market is actually one of the biggest markets in the world, okay? It is in fact bigger than the equity market. And so the U.S. bond market is actually $52.9 trillion. Yes, you heard that right. It is trillion with a T, okay? Trillion. So all of these numbers here that you see are all in trillions, okay? The second biggest country with the most amount of debt. And remember, we call bond markets the debt market because that's where people are lending and borrowing from, right? So the second one is going to be China. And then comes Japan, and then France, and then Germany, and then UK, Italy, India, Spain. And then I didn't really put the rest of them because they're less than 1 trillion. So it doesn't really apply, okay? It's relatively small. So the US is the biggest debt holder of the entire world, okay? They've issued the most amount of debt, all right? And we also call this the credit market because it depends on which way you're looking at it, obviously, right? So bond market participants are essential in providing buyers or debt issuers and sellers, the institutions that are selling that debt, capital for investments. And majority of these holders include pensions, banks, and mutual funds due to the specificity of the investment criteria. So sometimes mutual funds and pension funds, they have a specific target of risk management that they have to meet in terms of their portfolio risk balance, and therefore they have to mix in bonds together with it, right? So in the U.S. Treasury market, or the debt market, bond market, the majority of their bonds are in treasuries, and then comes corporate debt, then comes mortgage-related debt, then comes municipal debt, money markets, agency securities, and asset-backed securities. Now, I know all of these might be things that you don't really quite understand, or what the names might be a little blurry, but the easiest way to understand this is that treasuries are the ones that are issued by the Treasury, the U.S. Federal Reserve, and then it's bartered through the system with central banks through the main commercial banks and the Treasury. Remember that the Treasury is not the same as the U.S. Federal Reserve, right? The Treasury is the spending arm of the government. They control cash flow of the government. Versus the Federal Reserve, their policies are aimed at unemployment, stable prices, inflation, and etc., right? And of course, money supply. Corporate debt is going to be your C bonds, which are your corporate bonds. Mortgage related is going to be your mortgage-backed securities, which are going to be things like your mortgages that people take through commercial banks. Municipal, we just explained that. Money markets are going to be markets in which people borrow and lend money in a short-term basis, and the rest are not really that important since they're a very small percentage. But it's very important, or it's essential to know what or how, where these numbers come from, right? So it's good to get a good foundation. That's what I believe in. For those of you that are not familiar with the way that we do things at EGA, we like to use a process called peel the onion. We start with a big concept and we peel down the layers to the core so that you have a good foundation and you understand things from the ground up, okay? So next, I wanted to just show you that, in terms of the U.S. equity market, right? You can see that as of 2023 December, the U.S. equity market value was about $40 trillion, right? In fact, the top S&P 500 U.S. companies, their market value was close to about $33 trillion. Remember that in 2021, we hit peak, right? That was the highest the S&P 500 was ever at $42 trillion. So we have shed about, $9 trillion or so, through that time in that 1 year period. And so that's the amount of outflow that has gone out of U.S. equities and into other parts of the market, right? So just to give you that comparison, that this is 52 trillion and this is actually about 40 trillion right now, maybe a bit higher, but this is the latest numbers that I have, right? So how do bonds work, okay? How do they actually work? So let's talk about that a little bit. So bonds and interest rates are very tied together. The reason for this is because bonds themselves are a time value concept linked security, okay? It's just like any other security that you would own, you would expect a return for your investment, right? So let me just give you a more dumbed down approach, or a layman's approach. If you buy shares of Coca-Cola and you hold them for a long period of time, that's you're investing money into that company. You would expect a payment for that from that company, and Coca-Cola typically pays out a dividend, right? A dividend. And bonds are kind of similar in that regard. They do also pay out dividends, except for it's called a different thing. They're called coupons, okay? And we'll talk about coupons a little later in the next slide. But it's very important to understand that the anatomy of a bond is very similar to like dividends, okay? And that's the best way for me to kind of simplify it so that you understand it. But there is a direct correlation between bonds and interest rates, okay? So when interest rates go down, then bond prices go up. Why? Because if interest rates come down, then the bondholders start to command higher prices for those bonds, right? There is a seesaw almost effect, right? So with a higher interest rate, the converse would happen, right? So when you have interest rates that go up, the prices of the bond will go down. With higher rates or yields, then if there are newly issued bonds, the older bonds, right, would pretty much yield less. So the newer bonds would yield more because of the higher interest rates, right? And so when this happens, the prices of those older bonds will start to go down. Because imagine if you are somebody who bought a bond at when interest rates were kind of low, right? You bought the bonds here and the price of the bond was at 1,250, okay? By the way, most bonds, when we talk about the face value of the bond, they typically start at $1,000, okay? And people buy them in tranches. Just like an options contract that reflects 100 shares, typically people buy bonds in lots. And the bonds lots typically start in increments of $10,000 at a time, okay? So people would buy up to 10 bonds at the same time in one go, okay? And so if you bought a bond at 3% interest rate for that maturity period, we're not going to talk about the maturity periods right now, but we're going to talk about just the mechanics of interest rate and the bond price, right? If you bought it at that, we call this a premium bond because it's above $1,000, right? Then what will happen is if new bonds are issued and interest rates go up, then the value of the bonds start to come down, right? So as interest rates start to go up, the value of those bonds start to come down, okay? And then now, as it starts to approach that middle level at around face value, $1,000, then the interest rate of that bond starts to go further down. And let's say eventually it gets down to $750, then that interest rate goes up to 5%, right? So in this case, if you are the person who bought this bond at 3% and the interest rates are now higher and they are selling the new bonds that are being issued are at 5%, you would say to yourself, oh my God, I'm only earning 3% when I could be earning 5%, right? So as a person who bought this bond at a premium, then you would be thinking to yourself, oh man, I could get a higher yield, right? So you wouldn't want to sell that bond away, okay? You wouldn't want to sell that bond away because you would be stuck in that position. I'm going to relate all of this back to the SVB debacle that just happened recently. So make sure that you're paying attention because it is all has to do with that, right? So in this case, the prices of those bonds will go down, right? And if you wanted to sell your bonds, you'd have to do so at a discount, which is not favorable, right? You wouldn't want to do that. Why would you want to sell your bonds at a discount, right? Nobody wants to do that. This is the case that SVB was in just 2 weeks ago, right? So now we go into the anatomy of bonds, okay? And bonds have a specific anatomy. They have a bond value, which is called the issue price, and this could be either a premium or a discount, depending on where interest rates are, right? And a bond is purchased in the market for either that premium or discount at a specific interest rate, okay? And that interest rate is influenced by the supply and demand dynamics of the bond in lieu of economic growth expectations of the market, all right? Let me just move this little thing out of the way. Now you would realize that when we're talking about these bonds, they come in different flavors and different maturities, right? So bonds go all the way from 1 month to 3 months to 6 months to 1 year to 5 years. There's even 2 years, and then there's 10 years, and then there's 20 years, and then there's 30 years. Okay, and so I've just put this line here from 0 to 30 to reflect all of the years to maturity for all the different types of bonds. And by the way, they're called different things. When they are shorter term duration, they're called bills. When they're a little longer term duration, they're called notes. And then the longest ones are called bonds, right? So you have 3 different types of classifications. Let's just name it a little differently. But you don't need, they're pretty much used synonymously, okay? Now, each one of these bonds, when you buy them, they will have an interest rate, right? And so each time you buy a bunch of bonds, they will pay a interest. And that interest comes in a form of a payment called a coupon payment, okay? The reason why it's called a coupon payment is because back in the day, in the olden days, when you bought a bond, it would come as a certificate, okay? And then what would happen is that that certificate would come with coupons. And every single time, what would happen is when that time would come for you to redeem your interest, you would give that coupon in and take that interest payment as a exchange, okay? And so you would receive that interest, let's say 3%, 3%, 3%, 3%, 3%, 3%, until the time of the bond is over, the maturity comes. Then at the end of it, after you have invested that money, you receive the face value of the bond back. Okay? So once again, let's say you invest at the beginning $1,000, and this bond carries a 3% interest rate. Let's just, for the sake of simplicity, okay, 3%. And what will happen is over time, let's say you had a 10-year bond here, you would get that. And by the way, these bonds, they're paid either annually or semi-annually, the coupons, okay, for a period of the bond till the maturity, okay? So let's say semi-annually, then you get 3%, 3% for that 1 year, then another 3%, 3% for the second year. And this goes on until the 10 years are up. Once you receive that last coupon payment on year 10, assuming that you received it semi-annually, then you get back your bond value, okay? Now, it's needless to say that bonds with higher risks will obviously pay higher coupons. That means your C Corp bonds, right? Your corporate bonds, okay? But this dynamic of bonds allows the market to assign fluid interest rates, which is also sometimes called a floating rate, okay? So you have bonds with fixed term rates, you have bonds with floating rates, and there are many different types of securities in the market for all types of investors. A different flavor for a different person. Different strokes for different folks, right? So that's kind of the anatomy of bonds. Now, why do we need to know about bonds? How do they play into the equity market? And, you know, how does the bond market even help us understand things about the equity market? Well, it all kind of pulls back to something called the yield curve, okay? The yield curve. So let's talk about the yield curve very quickly. And I'm going to turn off my video for this slide because otherwise it's going to get in the way. So when we talk about the yield curve, and I'm sure that you guys have heard about this many times, but you're not really quite sure what the yield curve is. You might have heard it on news, you might have read it on articles, you might have seen it on Twitter, you might have heard people talking about it on Wall Street bets, right? But what is it? Well, the yield curve is a visual guide as to how yields, or the interest rate across the various maturities of these bills or bonds or notes, right, are varying based on economic concerns of investors. Okay. The yield curve measures the cost of funding for these various maturities that can reflect investor confidence in the country's economy. Now, the U.S. and Germany are by default considered nations that are risk-free. In other words, you can invest in their treasuries and not expect the country to default. Hence the term risk-free rate. When we talk about treasuries, they carry a risk-free rate. In other words, the yield that you get on treasuries is risk-free because it is backed by the full faith and the power of the United States government that they will never default on paying its debt. Okay. Other bonds from other countries can carry a higher yield to compensate for the risk they carry. So in comparison, maybe if you bought a bond from a country like Sri Lanka, which has got a very high risk of default, it would carry a very high yield. And so this all plays into the yield curve because there are two types of yield curves that the market usually starts to price in. The first kind of the yield curve is called the normal yield curve. Okay, this is when financial conditions are loose, when quantitative easing or the money supply is abundant, and corporate America has a lot of fuel to kind of go about their spending patterns. These are also long-term maturity. This is also when long-term maturities command higher yields than short-term maturities. So have a look at this chart here, which is where you will be able to see the difference. This is what we call the yield curve. Okay, so we're talking about this chart here on the left. Now, in a normal economy where everything is going and we are expanding and GDP is positive and the economy is growing, this is the usual way the bond yield curve would be. This is the yield on the y-axis, and these are all of the terms to maturity for the x-axis. The shortest maturity being here, and the longest maturity being on this side, the 30-year. So this being the 1 month, And this being the 30-year, the 10-year would be somewhere in the middle, okay, which would be the most prolific or most famous bond that is invested. On another side note, which is important, the 10-year bond is also what we use in finance to calculate valuations of stocks when we're doing valuations. This is one of the reasons why when bond yields start to go up, then we also have to increase the discount rate associated with those yields, which will cause the valuation of stocks to come down. Okay. So when we talk about the regular yield curve here, this means that in the short term, investors are commanding the lowest yield, right? Lowest yield, you can see this is the lowest yield percentage, right? This is in percent. And then on the other side of this would be the highest yield. That would be the longest maturity. So this would be the highest percentage. Okay? Now, in this normal yield curve, the longer term maturities, as I just mentioned, command higher yields than the short term. This is the default structure of yields because longer term certainty of the issuer is unknown and therefore carries a higher risk to reward ratio structure. In other words, in this market, the short-term investors are sure that the economy is heading in the right direction, right? And long-term investors are unsure where the economy is heading in the long run, which it should be that case, right? Because you can't accurately predict what's going to happen to the stock market in 30 years from now. Therefore, the longer-term investors will command the higher terms of interest rate, and the short-term investors will say, okay, the short-term market is predictable, and therefore, I will take this lower interest rate. If you understand everything that I've been talking about so far, say, good to go so far, or say, I understand, or just put a thumbs up so that I know that you're following along. And if you have questions so far, put questions in the comments so that I can answer your questions, because these are very important concepts to get before we move into the next big concept. So if you can just very quickly tell me that you understand, that would be great. Excellent. Now, the next part of this is to explain the inverted yield curve. This is a scenario when markets are not sure of financial conditions. This is a time when financial conditions are tightening. Does that sound familiar? It's kind of what is happening right now, right? When the Federal Reserve starts to perform quantitative tightening, pulling in the money supply from the markets, reducing effectively the reserve ratios that banks, the reserve capital that banks can hold, and creating a constraint on the market in terms of borrowing. Okay. When this happens, the bond market immediately reacts. And this reaction from the bond market spills over into equity markets. And this is why you need to master bond markets if you are an equity trader. More so if you're trading options, right? In this scenario, short-term maturities command higher yields than longer-term maturities. This entire system moves in reverse. Why? Because the market expects interest rates to decline as time progresses. And therefore, they command higher rates now to compensate for that opportunity cost later. So to put it in layman's terms, think about it if you are a bond investor and you didn't think that the short-term structure of the economy is going to be favorable. If I thought that the U.S. economy was going to collapse in the next 1 to 5 years, I would command higher rates of interest now, which is how this yield goes from this to this. And this is why the yield curve inverts. In other words, all of the terms to maturity start to flip on its end, because now the longer term expectation of the bond market is safer than the shorter term expectation of the stock market. It is assumed that the stock market will revert back to mean conditions in the long run, and therefore short-term bondholders are saying, I want that higher interest now. And that is why financial conditions tighten. Because short-term bondholders command a higher rate of interest, this causes the entire equity pricing to get out of sync. When you have higher interest rates in the short term, this causes lower valuations for stocks. And since tech companies make up the biggest percentage of the S&P 500 at a whopping 30%, and they carry higher betas or riskiness, those are disproportionately affected, and therefore the stock market as a whole comes further down. And we get a correction. These are times when bear markets happen. These are times when investors start to get finicky. These are times when speculation starts to go up. And these are times when investors flee the markets. So I hope that this kind of gives you a better picture and an easier picture on how these stocks or how these markets operate, right? Now, the next part of this is going to be perhaps one of the more important parts. And this is how the bond market interacts with money supply, okay? There are many players in this entire cast and this play that I like to call, okay? So let's talk about the entire system. How does money go from the Federal Reserve to you and your business? And how does interest rates affect that? And how does the bond market play into all of that? Okay, so let's talk about it. And it all starts with the Federal Reserve. The Federal Reserve has a balance sheet. Think of it like a business. The more things that the Federal Reserve has on its balance sheet, the more it has to take on in terms of its burden. Okay. And the lighter the balance sheet of the Federal Reserve, the less debt it has, okay? Because the Federal Reserve's balance sheet is mainly made up of treasuries, mortgage-backed securities, all of the things that I showed you earlier, right? And therefore, that is considered the debt of the entire economy, okay? Now, when the Federal Reserve wants to do quantitative easing or allow money to go into the system, they have to do so by conducting a operation through the open market operations, okay? And this is typically a operation that involves the Federal Reserve either buying or selling bonds to commercial banks. And over here you have Bank A, Bank B, and Bank C for your illustration. Okay? Now, these commercial banks are the banks that ultimately lend to you and businesses and the economy. However, they have to borrow money not set at the rate that they decide, but at the rate that the Federal Reserve decides. Okay? So this rate is what we call the federal funds rate. And this federal funds rate is decided by the FOMC. You might have heard of the FOMC before, right? The FOMC is your famous, the chair of the FOMC is your famous Fed Powell, right? Now, what is the FOMC? They're basically like a board, okay? Think of them like a board. They're like a board of directors, and there are, I think, 12 of them, if I'm not mistaken. There should be 12 of them, okay? So the FOMC, there's 12 governors, and they basically sit on different parts of the United States of America, and they will vote on what they think the interest rate should be. But this is not the interest rate that you are going to borrow from the bank, okay? This is the common misconception that majority of people have. This interest rate is actually the rate at which banks borrow from one another. That is right. So, the federal funds rate is the rate at which this Bank A borrows from Bank B, and Bank B borrows from Bank C, or Bank C borrows from Bank B, and vice versa. And when they borrow from one another, they do so usually on an overnight basis. They don't really, it could be for a longer period of time, but typically banks have reserve ratio requirements, and so they would usually borrow money from each other for a relatively short period of time. Okay. Then, based on the federal funds rate, the interest rate that you borrow is padded on. Obviously, banks are a business, and how do they make money? They make money by lending money out. So if you want to buy a mortgage, or you want to buy an island, or you want to buy a rocking chair, or you want to buy stonks, right? Or maybe you just, have an erectile dysfunction problem and you need money for that. You need to borrow it from the bank. And that interest rate is decided by the bank, but it's after they put on some of their own profits onto the federal funds rate. Okay? So let's say the federal funds rate is usually a target. And this target is typically, like, let's say, for example, 5.00 to 5.25%. Okay? The Fed will say, this is the target rate that we want. It's also called the terminal rate. Okay? So this will be the rate at which banks will borrow from one another. Now, what determines this rate? This rate is determined by the rate of money supply. If the Fed decides to pull money into the system, then they have to sell treasuries out to these banks. And they will sell the treasuries because when they sell the treasuries, what will happen? The prices of those bonds will go down, right? And if the prices of the bonds go down, then what happens to the yields? The yields go up. So the only way the bank will buy it is if it's beneficial to them, right? So the Federal Reserve takes on that money at a higher interest rate payment, right? Follow me so far? So if for example, in the current times that we are at right now, we're in a quantitative tightening cycle. The Federal Reserve will say, okay, we need to pull in money supply. This is also called the offloading of the balance sheet. What are they offloading? They're offloading bonds. They're offloading treasuries. They're offloading mortgage-backed securities. They're offloading securities that the bank is holding on the balance sheet. And they are offloading it. They're selling it. They're selling it to the bank. And if they're selling these bonds, that means the price of the bonds go down. And if the price of the bonds go down, what happens to the interest rate of those bonds? They start to go up. Are you seeing the system now? So that's how the system operates, okay? And that's how money supply works. Then, as the bonds are sold into the market and the cash is brought in, that causes a constraint on the amount of money available in the market, right? Now there's less dollars going around. That's why the interest rates start to go up. Because now it's more expensive to borrow money. Why? Because there's less of it out there in the system, right? So it's a very simple process, but not many people understand how this process works, and therefore it's very important to understand, because if you don't understand this concept, you will never understand why equities move the way that they do. And there is a saying that I like to tell people on the Everyday Growth Advisors Discord community. When the bond market sneezes, the entire equity market gets a cold. You need to be watching the bond market like a hawk if you want to understand how equities work. Because deep down from this entire cycle, that's where the liquidity crunch happens. And that liquidity is provided to the banks, and that bank's provided to corporate America, and corporate America is where equities are. So therefore, this is also another reason you would hear from people sometimes that if financials do bad, then the entire market suffers. This is the reason. Because if financials do bad, that means that interest rates are restrictive. And if interest rates are restricted, that means lending becomes more expensive. If lending becomes more expensive, then borrowing becomes more expensive. And if borrowing becomes more expensive, then businesses slow down in terms of economic activity. And this causes the entire system to feed on itself in a vicious cycle, into which I drop my pen. But you get the idea. And that's when people get helter-skelter about equity markets. Okay. So I hope this is enlightening to you and you learned something from here. If you learned something from here and you are following along so far and you don't have any questions, go ahead, drop in the comments, say good to go, so that we can continue on with this session. By the way, I appreciate you guys all turning up. And as you guys are typing in the chat and letting me know that you're okay, because there's a delay in the stream so I can't see it right away. I want to also let you guys know that this week we are starting a $5,000 small account challenge on our Discord. The last time we did this challenge, we brought the 5K account up to $9,000 or so, and we had it came down to about $7,000, and then the market got about really choppy at that moment of time, so I paused the challenge. What I've done is I've withdrawn the $2,600, I believe, that was in that account, and I'm starting that account at $5,000 again. You can sign up for 14 days for free to join us on this journey. A lot of people already have, and I see them in the Discord already. You can sign up through our website, learncompoundgrow.com. Click on the Discord community, scroll down, you'll see Wolves free 14-day trial. Remember that cancel if you don't want to stay after the 14-day period. If you want to stay with us and you find it lucrative, which I think many people here in the comments, if you are a Discord member here, please tell everybody how the Discord community works. And if you vouch for the Discord community, go ahead, put it in the comments so people know that, you know, it's the real deal. And we'll be happy to see you join us for the 5K challenge. We're hoping to bring it up, into a decent amount. And if we get to $10,000, we'll reset it to 5K again. And if we get to $10,000 again, we'll keep resetting it and just keep going with that. So I'll show you how to manage a small account during that 5K challenge. All right, I believe we're good to go. Now let's talk about the SVB fiasco. So now that you've learned all of this, you should be able to apply it and understand what happened with SVB, right? The Silicon Valley Bank debacle that just happened, right? And by the way, if you're enjoying this webinar so far and you truly feel like this has helped you, I would appreciate if all 60 of you smash the like button for me. By you smashing the like button, that is the only thing I can ask from you, because it will help this webinar reach a greater audience, and the YouTube algorithm will only share it with other people if you smash the like button. If you don't, then this webinar will just, not see other people, and that will be kind of sad, because I want this knowledge to reach as many people as possible. So I hope that you can just hit the like, and that's all I ask for you in this webinar. I truly appreciate that. So let's talk about the Silicon Valley boom. Now, this is also the quickest bank run in the history of the United States market. So this all starts pre-COVID, when VCs, or venture capital, which are basically investors that invest in startups and mid-growth companies, were in a boom era, right? And what happened was a lot of these VCs, they invested into businesses, and these businesses needed to park their money somewhere. So what happened? They put their money into SVB. SVB had positioned themselves to be the bank of Silicon Valley so that they can accept all of these deposits and give favorable terms to these investors. And what SVB did was that their balance sheet went 50% year over year for the first year, and then 150% for the next 2 years, peaking in 2021. Their balance sheet, I believe, went from $30 billion to $150 billion. And if you're a bank and you have that much money, you obviously want to lend it out. You want to make money on your money. That's the whole basis of deposits into banks. And since United States banks have the fractional reserve system, they can lend up to 90% of the money that people deposit into their base. Now, SVB, though, they did kind of a degenerate move, so to speak. Now, if you're an options trader, the equivalent thing that SVB did is that they bought basically either, they can go both ways, either a call option or a put option, but they bought a call option at all-time high, and they bought a put option at all-time low. That's kind of what they did, okay? In other words, they got FOMO, okay? Because at that period of time, they thought that the economy was going to boom forever. Okay? So it's kind of a degenerate move, in my opinion. What they did was they put a lot of that money into longer term treasuries. Specifically, they put that money into 30-year maturities. Now, I don't know about you, but I don't even know what's going to happen in the next 5 years of the equity market. And nobody actually knows what's going to happen in the stock market in the long run. Okay? Well, we do have the general understanding and so on and so forth. But this is when yields were very, very low historically. If you look at the bond market and the way the 30-year treasury has moved, in 2021 was the lowest yield that you could get for a treasury bond, especially the 30-year. Okay? And then what happened? The inflation started to go up, and the Fed said, okay, we're going to start the tightening cycle. And they started to raise interest rates. Right? Financial conditions started to tighten. And now you just learned about this in the prior slides. When financial conditions tighten, what happens to interest rates? They start to go up, right? And when interest rates go up, what happens to the value of bonds? The values of bonds, the actual price of bonds, start to go down. Remember, interest rate up, bond value down, right? They move in inverse. So imagine if they bought, I'm gonna give you the example, right? They bought these interest rates, remember the earlier example, right? 3% for the 1,250 bonds. And you know how much they put into this? They put $90 billion into this. Out of the 100 plus billion that they had, okay, they put 90 billion into these bonds. Okay? They bought them at $1,250. Okay? So in other words, they bought call options at the peak. I'm not even talking like pullback. They bought it at the peak. Okay? Like they went full degen. Alright? And they full ported it. Exactly. They full ported it. So they went like, you know what, all in. Okay? Now what happened? These treasuries devalued as the interest rates started to rise. Right? And now imagine that you are one of the VCs that put money into the bank. Right? So let's say I'm one of the VCs that put my money into SVB. Okay? And I put $1 billion into the bank. Okay? $1 billion. Hoping that I'll be able to withdraw it later if something happens. Right? So now, in this current situation that we're at, where the Fed has raised interest rates, we're in an environment where people want to take less risk. Right? And if you're a person that wants to take less risk, and bonds have sold off so much, remember that when bonds sell off so much, what happens to the yields? They go up, right? So what do you naturally want to do? If you're a VC and you want to diversify your portfolio, what do? You want to now invest in bonds, right? You might want to take a part of the 1 billion that you put into SVB and withdraw it so that you can invest in those bonds, right? It's the natural thing to do. So one of the VCs went to SVB and they were like, hey, we want to withdraw some of our money. And they're like, okay, here you go. Then another one comes, here you go. Another one comes, here you go. So bank depositors, they start to make withdrawals to invest in the now higher yield securities, right? And what happens? SVB has so much tied up in the long-term bonds that this $90 billion of bonds that they put into play has lost value, right? They lost close to $2 billion here, okay? The devaluation, all right, of the bonds. Now, it might not be a lot, but from a deposit-based standpoint, that is quite a fair bit of money. $2 billion is quite a fair bit of money to lose, okay? So now what happens in this is bank withdrawals couldn't hold the massive amount of deposit outflows, and this caused the bank to do two things that were the most stupidest things in the history of banking that I have ever heard. The first thing they did was they sold part of its idiosyncratic balance sheet. Okay? In other words, they already had full ported their portfolio. Now what they did is they sold those bonds after making losses. Okay? And they took a loss on those long-dated treasuries through the sale in the efforts to fund the withdrawals. Okay? That's mistake number one. Mistake number two, they announced that they're doing a share dilution to raise capital. And when asked if there was an issue meeting withdrawals, they said, no, we're good. Now, many of you know how dilution works. Shareholders don't like that. Imagine if I told you that I'm going to sell more shares of the business that you own. That's like printing money. That causes your shares to be valued less. And so this caused investors to panic, and a vicious cycle ensued, causing panic and more mayhem and withdrawals to lose trust in the banking system. Now, I think by now you understand what happened and how this entire fiasco played out. So then the Federal Reserve stepped in and they provided the insurance, and they said, you know what, we're going to guarantee the insurance. Okay. So that's a good way and an application to immediately learn what to immediately apply what you have learned and put it in a real world situation. This is what we do at EGA. We love to teach and apply based on a practical learning experience. Because if you learn and you don't know how to apply the knowledge that you've just learned, you're not going to remember it. And all the students that we have, they are applying everything on a daily basis with us in the Discord trading sessions and even in the course. So now let's talk about the Fed's balance sheet. And I'm going to move a bit quicker here because we're going to run out of time otherwise. So now the Fed's balance sheet. This is another area which we need to talk about. So the Fed's balance sheet has been growing, and so these are two charts. One of them on the left is from 2008 to current, and the other is from 2020 May to current. The reason why I'm putting both of these two charts here is because one is for the longer term after the financial crisis of 2008, and then the COVID crisis of 2020, and then the other is post-COVID, or rather during COVID, what happened. And I want to just explain that to you so that you understand that. So the Fed's balance sheet, first of all, is a consolidated statement of all the 12 regional Fed Reserve banks. As I mentioned earlier, there are 12 governors and 12 Fed Reserve banks all across America. And the balance sheet consists mainly of assets, which are government securities bought, and credit extended to banks. And then the liabilities, which are banks' treasury reserve balances on deposits, as well as the USD in circulation. So the function of QE and QT are two tools amongst the many things that the Fed has at its disposal to control money supply and slow or speed up the economy. This is why we actively talk about the balance sheet. And this is why the balance sheet is very heavily linked to the bond market. And then treasuries are linked to the bond market as well. Therefore, you need to know everything that I'm talking about in order to make accurate depictions of the entire market. Will this be available for replay? Yes, it will be only after 72 hours. The reason why is because we have a special announcement later, and therefore I want to be fair to all the people who are attending this webinar to take advantage of that special announcement, and that way the people who will view the webinar replay, they'll view it only after 72 hours, and that deal would have already gone by then. So all of you that are attending the webinar right now, it's a special. There will be a special announcement at the end, which will only benefit you. So the balance sheet has really increased significantly since 2008, right? We went, from just $2 trillion to a peak of about $9 to $10 trillion, and it's been increasing slowly. And so this was the big quantitative easing cycle, and then in 2018 we obviously had a runoff of the balance sheet, which caused a mini correction in the stock market, right? And then in 2020, we had the biggest quantitative easing cycle ever in the history of the United States of America. We went from almost $4 trillion all the way up to 9-point-something trillion dollars, almost $10 trillion, okay? And now, this is where we are. So we've come down a little bit from where we were. We went up all the way to, you can see, about $9 trillion, and we came down. The Fed has been running off the balance sheet a little bit, selling bonds, right? And then recently with the financial SVB situation, they pumped about $300 billion through a special Fed facility. Now, a lot of people are calling this quantitative easing, and I want to make sure that you don't get this twisted. What the Fed has done is not exactly quantitative easing. They have created very strict terms to lend on a short-term basis, which is almost like a reverse repo agreement, but for a 1-year period. Think of it like a more extended plumbing to the market, so that they restore faith back to the U.S. banking system in the short run. Okay. So where does the Fed go from here? Well, if you watched last week's Federal Reserve report, or the 25 basis point rate hike, Powell has already mentioned and already said that the Fed does not intend to stop running off the balance sheet. Okay, they're going to continue running off the balance sheet, and this $300 billion will pretty much come back off from this influx right here. This is just a temporary loan to the market for a short period of time to restore faith in the U.S. equity markets and the bond market. So that's all you need to really know about bonds, okay? And now we're going to jump into the 2022 recap and the current situation of equity markets. Okay, so what happened in 2022? And right before that, if you're good to go and you understand everything so far, and you learn something new about the bond market today, you finally understand how it works. Say, I finally understand how it works in the comments. And don't forget to smash the like button while I take a sip of water. Okay, so I like to check in with you guys every time that we, get into a different segment of this webinar, right? Because checking along with you guys and answering your questions as we go along will be much easier than reaching at the end, which, by the way, we'll have a Q&A at the end as well, so you feel free to hold your questions till then. But checking with you guys allows me to know if you're following along, and that's just great, right? So what happened in 2022? Well, we had interest rates rise, inflation rise, and as the effect of the Fed and the looming impending doom that money supply was going to get tightened, the entire stock market corrected in terms of valuation, right? Because money supply is getting tighter, you can understand that discount rates get higher for stocks, and therefore valuations come down. The idea that earnings will compress and companies will do worse was just one of the reasons why the equity markets started to correct. One of the worst performing sectors was the communication sector, also technology, right? Real estate, right? You had a bunch of these that did really, really badly. The best performing sector was energy, whopping 58%. Every other sector delivered negative returns on a year-over-year basis in 2022. The S&P 500 closed down 19.48% in 2022. And as of yesterday, the S&P 500 PE ratio currently stands at 21.23. In the peak of 2021 or 2022, the S&P 500 went up to close to 26 or 28 here. And now it has come down to 21. For some perspective, the mean S&P 500 PE ratio is 16 and the median S&P 500 ratio is 15. In all terms consideration, just based on PE ratio of the entire stock market, we are still considered slightly overvalued, right? And that means that valuations could still come down in the long run, right? In the long run. As long as financial conditions stay tightened and the interest rates continue to go up, the more equities will be constrained and tightened. So what do we expect in 2023? What is based on our research, what do we expect, right? So I've done a bunch of research for you guys, and it's very important to understand a couple of things. There is a current rotation of flow of capital out of energy and into cyclicals, technology, and industrials. We have been seeing this happen for a couple of months, and now we see that these sectors are also seeing outflows as of this week. Energy being one of the biggest outflows so far, with hedge funds and mutual funds being net short for the past 8 weeks in a row. Cyclical sectors are also seeing outflows, with the past 4 weeks in a row seeing some outflows. As the continued reopening of China is underway, there will be a focus on technology, financials, and industrials, and you can make investments in that emerging market through these proxies in KWeb, Azure, and FXI, based on your tolerance and your investment idea or your investment preference. We think that the yield curve will stay inverted in H1 or the first half of 2023 all the way through the late part of 2023, signaling a potential recession which is already underway. And we feel that earnings compressions will yet to be felt and will occur slowly throughout the entire year, frustrating both bulls and bears as this market continues sideways but tries to break out. In my opinion, the bear market is over. But it's just how long we take to get out of this sideways winding market and back to all-time highs, which will not happen until the Fed announces its signal to not hike rates anymore and start to cut rates. The continued strength in quality blue chips over speculative growth stocks or equities with formidable balance sheets will continue to be clear picks for the equity markets, in my opinion. And that's all that I have been investing in for the past couple of months. Everybody on Discord who knows me and knows what I've been buying good companies with strong balance sheets and very, very good competitive advantages to add to my portfolio over time. Because those are the businesses that will survive the test of high interest rates and high cost environments. So, couple of things. We are currently in a late cycle stage of the market. This is currently where we are. This is where activity starts to moderate, profits are under pressure, and there is policy contraction. And when this cycle starts to repeat itself, we go back to the end cycle, then we'll have the falling activity, profits declining, policy that starts to ease, and then credit spreads which will start to widen. By the way, what is a credit spread? Remember earlier when we were talking about the yield curve and we were talking about the left and the right part of it? So whenever you think about the yield curve in terms of maturity, and this is what we call the maturity line, right? Then the spread is the difference between a certain point here and a certain point here. If the difference is large, that means that economic conditions are uncertain, right? If the spread starts to tighten, then it's more predictable. So that just for your information, what credit spreads are. When policy starts to ease in the end cycle, this is where the markets already rally, just so you know. The market is already priced in peak pessimism at the moment. And even though US margins are shrinking, this was the fourth consecutive quarter of margin declines. Thanks to TS Lombard and Bloomberg, credits to them, and JP Morgan here. Sales, however, were up Q4 over Q4 in nearly every sector, which is interesting. But profits were down in all but two sectors, infotech and financials. So two of the biggest sectors. That's what's propping up the entire market. Not to mention, US personal savings as a percentage of disposable personal income have dropped into very low levels. In other words, spending is on a downward trajectory from the U.S. economy. I don't know about you, but one person's spending is another person's income, and if spending lowers and wages are not able to keep up, then the entire market moves in reverse, right? So even though there is a lot to hate about this market right now, there are some things that and pockets of the market that are investable. Now, here are some other secular trends that are going on. Now, Goldman Sachs forecasts that interest rates will remain high in 2023, which is not new to us. They're forecasting that interest rates will stay up at around 5.25 to 5.5%, which is the federal funds rate that I was telling you about earlier. And the debt will be at roughly 5.4%. US 10-year Treasury will be roughly about 4.2% by 2023 end. And by Stifel, I saw this really nice infographic that I wanted to share with you guys, that these are the more important sectors of the market or secular trends that you should be aware of in different phases of the market. Right now, we are going through something called a disinflationary boom. And you'll realize that these are all the different pockets of the market that are benefiting from this. Strong economic growth, but low inflation that will happen in the months to come. The market, for that reason, is starting to rally in all of these sectors. You already know that semiconductors have been booming. We've been calling semiconductors bullish from about 4 months ago when it was trading out of its breakout because of the boom cycle. Technology and hardware equipment, this is another sector. Retail is bound to come back at some point. Autos and components, software and services, we are seeing some of these come back now. For example, Salesforce, right? Media and entertainment, these are another sector that is now recovering. The ones that are running hot, this is where strong economic growth takes place and high inflation, transportation, real estate, insurance, banks. The banks just got clapped, right? Energy, capital goods, materials. Then you have the stagflation basket. This is where weak economic growth meets high inflation. This is where you have food, beverage, and tobacco, utilities, household and personal products, healthcare equipment, consumer services. These are more staples, right? And then you have the ice age, where weak economic growth and low inflation happens. That's pharma, biotech, food and staples, telecom services, and commercial or professional services. So it's very good to know in what area of the market you should be paying attention to, and that's why I put this graphic here, based on what is the 4 quadrants of economic growth. And that's how, obviously, we'll talk about the EPS versus the inflation, or how it affects the PE ratio. Now, another interesting thing here to note is that the S&P 500, it cannot rise unless the U.S. Financial Conditions Index eases. And we've seen the index easing already once before, just at the bottom here, okay? So we need this to continue easing as we head further up into a rebound here. One of the most important things that you can look for when you're trading equities to see if the market's about to go higher and higher is if financial conditions ease, because that means that borrowing is going to become easier, and that leads to the economy expanding. So this is another report by Stifel. I think this is also kind of interesting. They say, active but not broad-based management is meant to be in range-bound until the 2020s decade for equities. Value over growth, sell growth into S&P 500 rallies, and they believe this in the first half of 2023. Accumulate value during declines. What is your value? Your value is things like Microsoft, Apple, Google, Amazon. Amazon is actually more considered growth, like consumer discretionary sector, right? But your Google, your Microsoft, all those bigger market cap value companies here. Coca-Cola is also considered value in some cases. Small caps, how do you deal with that sector? Small cap value in reflationary recoveries. Only if we see that inflation is starting to fall, then we buy small cap. Non-US equities, these will rise if the US dollar weakens. So if the US dollar weakens, then you can start to buy other equities around in terms of EM, emerging markets. Defensive versus cyclical, how do you play these? Defensives in a recession fear, cyclicals when recession fear is gone. And they believe that this will happen in the first half of 2023. Hedge funds, macro hedge funds, Okay, you don't really need to know much about that. Or covered call options writing, where the S&P 500 is range bound or near the top of a channel. I think this is like basic stuff, right? Now, I just wanted to highlight these main things to you guys. I think it was helpful in understanding some of the guidelines for this year. I found it interesting and I found it helpful, so I want to share with you guys. Just a general guideline. So what do you buy in 2023? Let's move into that right now. Well, bond yields are attractive pockets of the market, right, within stocks. And obviously, as the equity market, there are some selective parts of the market within the equity market that are undervalued, okay? And this may be actually a good year to start a 60-40 portfolio. Now, for many of you that don't know what a 60-40 portfolio is, a 60-40 portfolio is a portfolio where you're invested 60% in stocks and 40% in bonds. And for most of you that have a 401k, this is a great year to allocate your portfolio in this structure. This is not financial advice, but this is just a good understanding that yields are adequately high enough for you to do this. Okay, you can buy a bond ETF, and you can do so by investing either in TLT or TLH. I've given you two choices here for longer maturities. Okay, you can hold that for a longer period of time, and they are commanding pretty decent interest rates. Of course, if you want to buy the shorter maturities, you can do so too. Those command higher interest rates because remember, right now we are in an inverted yield curve scenario, right? So for stocks, We prefer to categorize stocks in two categories. The first one is called hard landing picks, and the second one is called soft landing picks. Now, the reason why I've categorized them in this way is because it boils back to discount rates and how liquidity or lending and borrowing affects these stocks. Okay? So I've put together a list of stocks that are good for a hard landing. In another case, where the economy is going to go through a hard recession, these are the ones that you really want to take advantage of buying right now. Okay, if you think the economy is going to have a hard landing, if you think that we're going to go through a soft landing and the economy is just going to we're going to revert back to loose monetary policy, then these are the ones that you want to buy, because these companies require pretty significant spending, higher levels of spending. Okay, for example, Tesla requires a lot of capex. Amazon, same thing. Salesforce, you might not know it, but yes, same thing. Adobe, same thing. Triple M, same thing. Google, same thing. They spend a lot of money on their revenue acquisition. And Meta is currently going on an ape shit crazy spending spree, right? So all of these soft lending picks, they require the economy to be somewhat softer, the financial conditions to be softer. But in the hard lending, where we expect financial conditions to be hard, to be where lending is going to be tougher, then these are the businesses that you want to buy because they're considerably undervalued and detached from their intrinsic values. For example, Activision Blizzard is about 20% undervalued. Home Depot is about 15% undervalued. Costco is currently about 10 to 15% undervalued. Altria is about 20 to 30% undervalued. Baba is currently about 80% undervalued. United Health is also 20 to 30% undervalued. I've done the valuations myself and I share them with the team. Baidu also about 40% undervalued. Visa and MasterCard both about 10 to 20% undervalued. Microsoft 20% undervalued from its intrinsic valuation. So these are stocks that you want to pick up on a discount because they have competitive advantages, they are good companies that have economic moats, and they are leaders in their space. Activision Blizzard, leader in the gaming and that space for entertainment and communications. Home Depot, leader in home improvement, leader in that retail space. Costco, leader in consumer staples. Altria, seller of addictive products, right? Alibaba, leader in Chinese tech market and also e-commerce. United Healthcare, leader in healthcare. Baidu, leader in internet search in China. Visa and MasterCard, the competitive, there is no other competitor to Visa and MasterCard except for Amex, and Visa and MasterCard are considered staples. By the way, I would like to also mention that Amex is actually not a bad buy, but I didn't put it here because they don't have such a rosy balance sheet. Microsoft, need I say more? Microsoft has got probably one of the most robust balance sheets ever, right? In my opinion, Microsoft will overtake Apple in terms of market cap in the next few years to come. The next 5 years, 10 years, they will overtake Apple. Because Apple has lack of innovation and Microsoft takes over there. You realize Apple's not even here for me. Why? Because I believe that Apple is overvalued, so it's not here. Simple as that. Can you explain fundamentally why you would buy Tesla? It seems very overvalued. Tesla is actually not overvalued. Tesla by valuation is currently trading undervalued. Now, the reason why Tesla is a possible undervalued stock, and let me explain this to you in a nutshell in less than 1 minute because I want to carry on with the slides, is Tesla has a first mover advantage, number one. Number two, they have penetrated the network for charging, and they're now being incentivized by the U.S. government to put chargers out. There are other companies that are trying to move and encroach on their space in terms of competitiveness, but Tesla has a very elastic pricing mechanism in terms of demand. Therefore, they're able to push their supply price down and take advantage, even if they take a loss in the short run. They are the only probably EV car maker that went all in, that is free cash flow positive as of the past couple of years, right? That's another added benefit. I'm talking from the financial perspective. And they have invested a lot of capex around the world, building and seeding their factories in building that infrastructure so that people can take advantage of those networks. And not to mention that obviously they have a kick-ass product, right? The Tesla car is one of the biggest one of the bestest EVs out there, right? Now, many people, as I mentioned this many times before, Many people think that Tesla's biggest advantage is all of those things that I mentioned, but let me just tell you that their biggest advantage lies in their full self-driving feature, because they have collected a lot of data, and that data is worth a lot of money. Okay, and that's one of their biggest IP benefits, and they will never ever sell that away. I don't think they will never allow other people to know how FSD works to the full degree, and I think that that's one of the biggest things. Like in the years to come, when Teslas all become autonomous, what will happen is people will really fight for the rights to own that Tesla IP, and I think that will be very valuable for Tesla in the long run, because that ability to drive the car, remotely or so on and so forth, which by the way Waymo already does right now. I think it's a very interesting thing. So yeah, that in a nutshell, that's what it is to me personally, competitive advantage wise. Okay, let's move into the next and final part of this webinar, which is the psychology of the markets. Okay, and I want to really talk about a few key things that traders make, some glaring mistakes that you guys make. Even investors make these mistakes. Okay. And as I go through these, I want you to tell me if you have, if you're a victim of some of these. Tell me if you experienced some of this, because I think it'd be interesting to know your journey. So, number one, overtrading. This is probably one of the most important things that people suffer from. Okay, you don't concentrate on trends or secular trends, but rather you look at the market from such a magnified view that you only see individual names. In other words, you turn up to your trading sessions where you're just looking at one chart or two charts, and you don't look at the whole market as a general. You're jumping in and out of too many plays all the time, and you're paying too much in commissions. This is one of the biggest mistakes that people make, and I'm going to obviously go through all the mistakes first, and then I'm also going to talk about some of the solutions and some of the ways that you're going to avoid these, right? So we have a saying in the AJ Discord. It's our motto, right? You plan the trade and you trade the plan. Every time before you get into your trading session, if you don't have a plan, you're not trading. It's simple as that. Okay. It's the same thing for investments. If you don't go and do thorough research or due diligence, how are you going to invest in something? If you don't know how to read a balance sheet, learn. If you don't know how to read a 10K or a 10Q, learn. There are many resources that allow you to do so. EGA's resources allow you to do so. You could take the EGA course and you would benefit greatly from that, right? We teach everything from start to finish. Another thing that people do, trying to top calls, they try to top bottoms and tops. And I think many of you probably suffer from this, right? You try to get the best price to get in. You're like, no, it's going to go up further. No, it's going to go down further. And then you ignore the basics of risk management, or the logic that swing highs and swing lows requires some risk taking to some degree. Many of you are so obsessive in wanting to nail the entire move that you forget why you're trading in the first place. Because let me tell you that we have another saying in the EGA Discord. Does anybody know what it is? Come on, I'm pretty sure that some of you know what it is. You don't eat the... I want somebody to say it, because I'm pretty sure some of you will actually know what I'm talking about, right? So the idea as a day trader is that your job is not to be there for the entire move, okay? You don't want to eat the whole fish. You just want to have the juiciest part. In other words, in the entire move where you catch a trend, a movement, your job is not to catch from here to here. Your job is just to catch it midway, but do this so consistently that you're confident in your move. And that's what sets the professional traders apart from the beginner traders. Because you want to be right in your head so many times that you forget what you're doing to begin with. And this is a big problem. It's an ego problem. It stems from the reason or your own belief system that you want to be right and you don't want to accept anything else. It's kind of problematic, to be honest. Now, number 3, stop loss management or risk management to begin with, right? You let trades get overly red and you don't move your stop losses into profits when your trade is in green. You don't even think about scaling positions. You just go all in. I have $5,000 buying power. I'm going to go $4,000 and keep $1,000 for a rainy day and hope that I don't lose it. and you just go all into the position, and then you're like, oh yeah, but I'm going to keep a 90% stop loss. Okay, that's cool. But then when the time comes to actually respect your stop loss, you're like, you know what, I'm going to move it. You know what, no, it's going to go. You know what, no, it's not going to stop out. And then you keep moving your stop loss, and then you lose all your money. If this is you, you need to seriously take a check at what you're doing. This relates back to your plan. The reason why this happens is because you're not following a plan. Okay? If you had a plan, you would not do that because you're following your plan. Another thing is, a lot of people tend to think that stop losses are a bad thing. In other words, if I get stopped out of my trade, they start to feel shitty. Like, oh man, I got stopped out. Worse yet, these are the worst scenarios, is they get stopped out and then they revenge trade. They don't follow the plan entirely and they think to themselves, oh man, now that I got stopped out, I need to revenge trade this money back. I hate being wrong. Guys, it's okay to be wrong. And when you hit your stop loss, that actually means that you followed your trading plan. And that is a great thing. Come back tomorrow with a fresh head, a fresh mindset, and try again. Because if you follow your risk management rules, you will come out in the long run. Many people don't realize this. Okay? And that's how we bring these small accounts up into the 5,000 to 10,000. We do it slowly. It's not like I do it over a week. We do it over a month. The last time we went from 5,000 to 9,000 in like 3 weeks. It was slow. It wasn't like overnight. Okay? Now, the next one. Ignoring risk management. You focus on signals instead of education. You're constantly jumping from one Discord group to another. And you're constantly finding for the next edge. You follow trader A because, oh, this guy has one way to do things. Oh my god, he's an Elliott wave specialist. You follow trader B because this guy is using a momentum trading strategy. And then they tell you, oh, I'm going to teach you a 15-minute candle special thing which will get you profitable. Or they tell you, I have a 90% success rate in trading. All which is complete BS. At EGA, we never ever tell you that trading is easy, number one, or that you should focus on high success rates, number two, or you should focus on anything that is working on your own style of trading. Other than working on your own style of trading, you should not focus on anything else, because everybody is unique and what works for me will not work for you. But what I can do for you, and what EGA does specialize in, is helping you find that path. It's helping you determine what your specialty should be. And that's through one-on-one coaching, and that's through giving everybody that individual attention that they deserve. That is what EGA comes in and helps you to do. Right? Through the live trading sessions, you can ask questions. You hear my market commentary while we're going through the entire thing. While we're taking a trade, I'm telling you how to move your stop loss. I'm telling you what to do, where to go, what to be aware of, what to watch. Those are all profound things, right? When you are just focusing on following signals from other people, what are you doing? This is the equivalent of cheating on an exam and hoping that the teacher doesn't catch you, because you don't really learn anything, number one. Number two, your risk management is completely different from that person. You might be okay with losing $500 and that person okay with losing $5,000. You might exit the trade much earlier than they do because your risk tolerance is lower, and therefore you find yourself never profitable because you keep chasing their risk, which keeps you in a very detrimental state for your own process of learning. And then lastly, you rely too much on either TA or FA. Now, I know many of you come from either schools. And obviously, if you're a COVID trader, and I refer to COVID traders as people who have started in 2020 since the COVID boom, you're probably a statistician and a chartist. But you need to learn the other parts of the market. If anything, today's webinar should be a big eye-opener that if you didn't know about the bond market, this is a fundamental part of market structure that you've been missing. And you need to learn that part of the market. In other words, fundamental analysis tells you what to buy. Technical analysis tells you when to buy it. And this is something that you have to understand. You need to know both. I personally use a 60-40 approach where I use 60% coming from macros and fundamentals and 40% coming from technicals to help me understand and guide my trading strategy. That might not necessarily work for you, But you should put in effort in learning both sides of the market because you need to understand market structure, which is another thing that EGA's courses focus on. We teach you market structure and who are you trading with? Who are the counterparties that you're dealing with? So where the heck do all these behavioral mistakes come from? Well, there are 4 major areas. The first is self-deception. This is where we mistakenly think we know more than we do, missing key pieces of information that is really necessary for key decision making. And I don't know if you guys have heard of Daniel Kahneman, but this is a part of, or rather comes from his book as well, so partly credit to him. He talks about 2 systems that the mind goes and has, okay? There's 2 systems, system 1 and system 2. Your brain has 2 systems. The system 1 is a passive system in which if you see a number of patterns, for example, number 1, 2, 3, 4, you will quickly assume that the next number in that sequence is 5. Whereas the system 2 in that same pattern will take a second to stop, analyze, and see if there is a deeper understanding towards that process. Now, majority of traders, they operate in system 1. They're operating passively. They see prices go up, they buy. They see prices come down, they sell. That's why a lot of people lose money. And that's why that statistics of the market that's floating around where 90% of traders fail, right? Which, by the way, it's not true, in my opinion, right? You need to engage system 2 actively every day when you trade. In other words, you are not only questioning what is happening in the market, but you're questioning yourself. This is a very important part of trading that many people overlook. When you come across a trade idea where you think that something is going to happen and you are very biased towards it, you need to entertain the idea that that can go wrong very quickly. And you need to entertain the idea, how much can you lose instead of how much can you make? This is one of the things that sets professional traders apart from beginner traders, because we don't fantasize about how much we can make in terms of money. We fantasize about how much we can lose. We always focus on risk management as the primary criteria for taking a trade. How much am I going to lose in this trade if things go wrong? The next is social influence. And this is how our decisions are influenced by other people, news, friends, family, or advisors, right? And honestly, this is a big one because sometimes you read news articles and you get sidetracked. Sometimes you hear from friends and they tell you, oh, you know what, I heard from this person and this is going to happen. And then you get sidetracked. You get biased. You have to remain non-objective. Your biases will kill you if you do that. Next, heuristic simplifications. This is where you make simple information processing errors. An example of this is where you see, for example, inflation going up and you automatically assume that gold prices will start to go up. Or you see that the NASDAQ starts to sell off and you automatically assume that one pocket of the market or a specific stock will go down. These are simple information processing errors that you go through that you have to validate on your own. And the last is emotions. And this is probably the biggest one, right? How many of you think that emotions is the biggest behavioral mistake or the biggest behavioral problem that you experience when you're becoming a trader and an investor? How our mood affects our decision making during different phases of our lives affect our trading career if you don't realize that. How you do things on a daily basis is going to affect your life. If you woke up and your wife shouted at you and told you that, hey, you didn't make the coffee, you didn't make the bed, you didn't do this last night, you didn't take the trash out, and you get into your trading session feeling all that negative energy, the chances are you're going to bring that negative energy to your session. This is the reason why I say meditate and try to collect your feelings and your emotions before you trade. Breathing exercises typically help me. I sit down and I'll be sitting with myself and I'll breathe in deeply and let it go. At least about 10 to 15 times while going over the trading plan in my head, which I've already gone through the night before. And if my trading plan doesn't activate, I don't take the trades. I don't trade for the day. Many times I've done this. And many times people might say, oh, why didn't you trade today? The point of the matter is, not every day is a trading day. Some days you just simply don't trade. And that's the thing about trading. It's a boring profession. If you want exciting, go to the casino. Trading is not exciting. It is the most boring profession. It can be very lonely. The path towards becoming a trader and a professional trader is the most lonely thing you will do, because you're waiting around most of the time, waiting for things to happen, and when they do happen, you have a short period of time to react. That's the reason why it is a tough profession. So here are some tips from my experience, and here are some gems. Like, honestly, I think that these are really big gems, and if you read these and you internalize them, you're really gonna experience a big change in your trading journey. Let's go through them one by one. Number one, accept all scenarios. Nothing is guaranteed in the stock market. Inflation doesn't have to go down and trend down perfectly. Gaps don't always have to fill immediately. A supply and demand zone doesn't always have to get immediately retested. The faster you understand this, the better it's going to be for you. A lot of traders like to oversimplify concepts, and they see a gap and they're like, oh, but it could go for a gap fill. And then they start salivating like, oh my God, it's going to go. And they don't realize it could go the complete opposite way. Your main focus should be risk management. How can I manage my risk in that position? Am I getting good money for my odds? If I put down one risk, am I getting more than one return? That is the most important thing here. Okay? Don't salivate. Don't get excited. A lot of people get excited. They're like, oh man, I'm going to make so much money on this. I'm going to go put my whole portfolio on this because it's going to gap fill. This is the stupidest thing I hear from people sometimes. Retail traders, they oversimplify things so much that I'm not going to say it pisses me off, but it really disappoints me, because you need to surely realize that things will not go according to your plan. You have to be aware of that. Second, be aware of the utility of your money to you. Okay? Trade using money that has low utility instead of high utility. What does that mean? If you have to pay rent, please don't use that money to trade. If you have put money aside to buy a house, please don't use that money to trade. If you have put money aside for your education, your healthcare, or any other thing that is really important to you in life and has a very high utility, please don't use that money to trade. Why? Because the higher the utility, the more emotional connection you have to it. Imagine if I was trading with my rent money, right? Imagine that versus me trading $5,000 that I just had as FU money, right? The difference in the way that I treat that money would be huge. By the way, this is one of the reasons why you go through something called loss aversion. If you don't know what this is the concept in which losing money feels worse than gaining money. When you make profits, you don't think of it like you did something well. And when you lose money, you feel the burden of that loss a lot more. Why? Because you've used money with a higher utility to perform that function. This is the psychology of trading, and the part that no one talks about, which I'm highlighting to you. More importantly, if you're going down this path and where you're mentally drained and every single dollar you trade has a certain amount of intensity linked to how much you really have to profit, you keep focusing on that, you will not be able to remove emotions from trading. This is 100% of the time what affects majority of people. Because you have this sense of urgency that you need to make money. And this causes you to entertain yourself. It's almost like you pay a fee every day to the market to entertain yourself. You keep thinking to yourself, man, I have to make money today. And if you don't make money, you feel disappointed in yourself. How many of you have gone through this? Be honest and tell me in the chat. This is a big problem for traders, right? And you can't say that you disagree with me, because I know this is true. Number 3, where does your disappointment and discomfort come from? You have to be able to recognize this. Your fear often stems from disbelief in yourself and your confidence in your own belief systems. If you cross into the state of euphoria where you fail to perceive risk, which will cause you to break your money management rules, then everything becomes mayhem. Because of the state of euphoria, you tend to take on more risk because you don't think anything can go wrong. Let me give you an example. The stock market starts to rally. Everybody around you is like, yeah, let's go, calls. Everybody's buying everything up. And at that moment, everybody doesn't realize that they are in a state of euphoria and the prices keep going higher and higher and higher and higher, right? One person passes their bag of shit to another person, that person passes another bag of shit to another person, and prices keep going higher until the last person has passed the bag of shit to the highest and the most idiotic person. That's when prices start to collapse. The reason why this happens is because you have overconfidence in your belief. And the lack of confidence is what causes the opposite of this cycle. So having the understanding of where your ego level is and understanding where you are in this process is a huge thing. You need to work on yourself more than anything in the markets. Number 4, the journey of a trader is very, very difficult. Okay? You initially start with a lot of lessons. You learn those lessons, and those are the biggest hurdles to cross. But eventually, you learn from those lessons and you internalize them. Then you come to a point where there are lesser lessons to learn, and it just boils down to straight discipline and patience. This is where you come to after a long period of time. And then it's just a matter of waiting for the right setups to form, the right conditions, and that's when you realize that this is actually super boring, repetitive of a profession. Lessons go from having a lot to having few, and you gain new skills. This is typically the journey of a beginner trader all the way to becoming a professional trader. You start learning a lot of things, you have a lot of things to learn, and then you realize, well, you know what, now it's just a boring process. I know exactly what I'm good at, I know exactly what I'm looking for, I just have to wait for all of those things to align, and when I'm comfortable, I will trade the market on my terms instead of letting the market dictate where I'm going to trade. Lastly, if you fail the plan, you plan to fail. Simple as that. Plan the trade, trade the plan. Fear, uncertainty, and doubt is coming from being underprepared. You're likely not committing to the path of preparing before each session and having a game plan ready for each scenario, which keeps you blocked in terms of your own mental bandwidth. Let me explain to you what majority of you are doing, and if you feel attacked, I'm sorry. Majority of you start your trading day like this. You wake up, you have some coffee, and then you sit on your desk and you do about 30 minutes to 1 hour of charting, maybe even at that. Some of you maybe don't even do that. And then maybe you subscribe to a Discord service and then you turn up and then you listen to a bunch of things from someone and then you're like, okay, I'm ready for the trading session. Let me just tell you, if that is what your process of preparation sounds like, you're in for deep trouble in the long run. Because the work for what you are trying to do starts the night before. You need to chart all the scenarios, not just the bullish scenarios, but the bearish scenarios. You need to be prepared for the index to bounce, rally, and reject. You need to be ready. What are the trades that you're going to take? What are the strike prices that you're going to take? Where is your exit going to be? Where is your take profit going to be? You have to have all of this meticulously planned, because if you don't, then what are you truly doing? Are you just sitting there and pressing buy and sell when you think it is the right time? And do you really think that's going to bring you long-term profitability? If you think that's going to bring you long-term profitability, I'm sorry to be the bearer of bad news and tell you that this is the reason why you're unable to attain profitability. Okay? And why do people feel like that? Because the truth is, and the reality is, that most traders and investors lose money in the stock market. And this is because they don't have a proper education or support system. They think of their entire way of trading as a luck-based system. If I get lucky, I'll hit it big and then I won't have to trade anymore. But they don't realize this is a long game with long players. And this is where EGA steps in. So we provide a complete trading education and mentorship program that does not rely on just feeding you with signals. In fact, we have one-on-one coaching and live trading sessions during market hours, right? The live trading sessions are meticulously tracked. Every single trade we take is put on a Excel sheet, and that Excel sheet is is shared weekly. My yearly P&L is shared every single week. I even do a trade recap every single week, and I tell you what has happened. And during the live trading sessions, you hear all of these trades being called out, exactly how I manage them, and obviously with some of the gains come losses. There are weeks that I even lose money, right? It's the reality of the situation. So we have the new version 3.0 course that has just launched about a month ago. It's a self-paced course that teaches you about growth investing and trading. There's about 120 lessons with lifetime access. It includes a graduation certificate and quizzes as well. The curriculum is extremely comprehensive. And so what is going to be included in this course? You're going to master risk management. You're going to master how to build a diversified portfolio and how to value your own stocks. I'm going to teach you about valuations, how the stock market works, technical analysis, options trading, deep dive, over 120 lessons with lifetime access. There will be quarterly webinars and also exclusive access to our Telegram group chat, as well as a free trading journal and the DCF valuations Excel sheet. Now, for this entire webinar, I wanted to put out a special offer for you guys, and so this is where that special announcement comes. We're offering currently 20% off if you buy just the course only, and 30% off if you take the course with the Discord access. Now let me just explain to you the differences between both of these so you understand. If you go down the route of taking just the course, this is going to give you just the course access, and this will not give you the practical approach of learning and growing with EGA. If you take the 30% off bundle, which will give you both the course plus 1 year's Discord access, what's going to happen here is that you're going to get 1 year of access to our Discord at a considerable discount. And this will give you that after course effect of learning where you're in an internship experience with me personally. You'll have one-on-one coaching sessions with me as and when you think it is necessary. And through those coaching sessions, I'll be able to work on you on a personal basis to help you to find your own trading style. No, this is not a promise to get rich quickly. This is a promise to help you find your own trading style and help you in your journey towards financial success. In other words, cut short that trading journey. Instead of you taking 10 years like I have, this will cut short your trading journey to a 1 year period where you will learn everything that I know in under a year. And through that process, you'll find your own style, and through there, you'll be able to find your own pattern and your own success in trading. All right. So for this webinar, you want to write down the coupon codes. It's going to be EGA 20 off. EGA, all caps, 20 off. OFF, which is capital. This is a 0 and this is a O. Okay. And for the 30%, which is applying for the bundle, which is going to be the Discord access plus the course, it's going to be EGA 30 off. So this is a 0 and this is a O. Make sure it's all caps. Here are some testimonials from students, and these are people that are very real. If this is your testimonial, can you please drop a line in the chat and say that's me, or tell just say that it's actually you, because I want people to actually see that these are real testimonials, and I'm pretty sure that I pulled some of them. Some of you are actually going to be here, so I'm hoping that some of you will be here. So this is Jonathan Savage. He's one of our Discord members, and he's been with us for a extended period of time, and he took EGA courses a while back, and he's been with us for a while. I'm not sure if you're here, Jonathan, but if you are, please let us know, right? And he said, I've been taking this course for a few months, and the only regret is I didn't do it sooner. There's so much material out there, not even in the courses, but not very many seem to be live and in real time with the current market conditions, which makes a huge difference. So there's so much material, and I think he really enjoyed this. So obviously this was the live courses that we had in the future, but now the real world application of the current courses are also very similar because you get that live experience along with me. This is also APD. She took the course a while back as well in 2021, and she said, I rewatched both courses together and everything has clicked in place and made more sense. I truly appreciate the entire system because you can see everything he teaches be applied on a day-to-day basis during the live trading sessions. And this is Malik, who is also a longtime member of our Discord. Just had my one-on-one session with T, and it was very, relieving that he was able to identify my exact issue spot on, give me solid direction. This is Dhruv, also a long-time member. Just had my first one-on-one session with T, and it was very relieving that he was able to identify my exact issues spot on, give me solid direction. These are just some things I wanted to highlight. So that's all I have for you guys today in terms of the webinar, and I want to open it up for Q&As now on the session. So go ahead and drop your questions, and I'm going to answer all of them right now, so that we can get this webinar sorted out. Does anyone have any questions with relation to the webinar? Any questions at all? Let's see. Very many times. I set a stop loss once on SPY put option. My stop loss was the low of the day for the option, and it rebounded 3 times. Oh man, Miguel, I'm sorry to hear that, but yeah, that's why risk management is super important. Let's see here. Taking on their risk. 110 emotions can make or break you as a trader. I agree, 100%. Most definitely, very many times. Yes. Boomer. Oh yeah, boomer. Okay, no questions? There can't be no questions at all, right? Come on, I'm sure that some of you have questions. For the rest of you, remember we have the 5K challenge. Make sure you sign up through the 14-day free trial. I believe I've put the link in the description below. You should be able to access it in the link below. Or if not, you got to visit our website, learncompoundgrow.com. And you'll be able to see it under the Discord access. You'll see Wolf's 14-day free trial, and you can join us, for that during the live trading sessions this week for 14 days. Okay, I don't really see any questions. I guess this is where the live is going to end. Now, this live replay is not going to be available until the next 72 hours. Just to be fair to everybody who has attended the webinar, I want to make sure that the coupon codes are only applicable to you guys for the next 72 hours. I will be sending out an email reminder about this, so expect one final email from me, and I will send out the webinar coupon, the coupon codes for the webinar. The current Discord members get a 30% discount to EGA 3.0 only. You can use either coupon, Eddie. You could use either one. If you're a current Discord member, you can use either one of these. It just depends on what you're taking. If you're taking the course only, then that's 20% off. If you're taking the course plus Discord, you can take 30% off. But yes, you can use the 30% off for the course and the Discord. It will add the time to your existing time if you have it. So, for example, if you have a yearly and you just purchased the 30% off bundle with the course and the Discord, what will happen is you will get the course, and then it'll add time to your existing time on the Discord subscription, if that's what you're asking. So make sure you know the coupon code, and yep, I hope I answered the question. All right, well, if we can get one last wave of likes, I would truly appreciate it. I want to thank all of y'all from the bottom of my heart for attending this webinar. Thank you very much for taking out the time to be here. And okay, let's see, that's a question. How exactly do bond traders make money? Do they go the route of fundamental analysis, looking for underrated bond ratings that are undervalued, hoping that it gets an upgrade? No, that's not how it works. Mainly, bond traders are looking at interest rate expectations. As I've mentioned, the biggest correlation between bonds and interest rate its counterparty things that are with bonds is interest rates. So when bond prices go down, interest rates go up, and so if interest rates go up and down, that's what bond traders are mainly looking at. What is the economic performance? What is the perception of the economic performance? Is the economy going to become stronger or weaker? That's what bond traders are looking at. And so if the economy is going to strengthen, then they will want to take longer term bonds. If the economy is going to weaken, then they will take shorter term bonds, and that affects different types of bonds, corporate bonds, as well as treasuries and municipal bonds. They all have different ways to be looked at. What about people who invest in futures? Isn't it basically investing on margin? Yes, it is. Futures market is another market that is on the side of the actual stock market. So just like how there are futures markets for almost everything in the world, it is a market that operates at on the same plane, but on a different instrument. So it's like another instrument created for people to bet on the future of that market. So futures are kind of like an extension to the existing stock market, but they're not. I wouldn't say they're 100% correlated. Would you be able to further explain on how a convertible bond trades differently with yield curve expectations versus a standard bullet bond? Sure. So convertible bonds are bonds that have an additional feature to them. Now, obviously, I'm going to dig back into my master's in finance here. So convertible bonds have an additional feature in which they can be exercised for shares. Not only that, it comes with a rate of return that will fluctuate based on the share price. So if the expectation of a company's and typically convertible bonds are traded for businesses rather than any other kind of security. So when we talk about convertible bonds, we're talking about, first of all, corporate bonds. And when we're talking about corporate bonds, we'll be talking about the performance of that corporation in terms of horizon. So if we think this company is going to do well in a certain period of time, and we want to take some convertible bonds in that company, if the expectation that the company is going to do well, then we will likely take that convertible bond at a lower interest or a lower payment for interest. And when the yield curve expectations in the short run, they start to run up. Let's say, for example, the situation is as of such right now, where the yield curve inverts. Then that causes the yield of convertible bonds to go down, because the risk of corporate companies defaulting is higher. That's where your credit default swaps come into play, CDSs, which is another thing that was highlighted in the Big Short movie, right? I'm not sure if you know what credit default swaps are, but as people start to purchase more credit default swaps, that increases the likelihood of corporate companies defaulting on their bonds, and that increases the rate of return on these convertible bonds. So if it's a safer investment, the conversion rate gets lower. If it's a more risky investment, then the conversion rate gets higher, basically. That, in a nutshell, that's how it works. I hope that explains it for you, Darren. All right, any other more interesting questions? But how can they profit just based off interest rate change? If a bond is $100 at 5%, interest rate goes down 2%, the present value would be $103 profit, but how is that sustainable? Because over the long run, that $103 bond will move back to the face value as interest rates adjust back. All depends back on the maturity of the bond in most cases. You have to always remember that if a bond is bought at a premium or a discount, as it goes towards maturity, it will be bought back at face value, which is $1,000. So the interest rate will start to adjust based on that expectation. As the bond gets closer to maturity, the interest rate will fluctuate on that bond, and the expectation of that bond will fluctuate. Great, thanks on the idea of perps. Investors are buying only solely for the chance for it to be called, right? Since there is no maturity to face. Yes, correct. For convertible bonds, that is the case. Yes. Convertible bonds are an interesting space right now. There's a lot of opportunities in them, actually, but I personally don't trade them because I know what I'm good at and I stick with that. This is one thing you need to understand. If you're good at something, stick with what you're good at. Don't, look at too many different things. It's like putting your hand in many cookie jars, and that's not really going to be beneficial for you in the beginning, at least. You could obviously, if you have a master's in finance or you're proficient in finance, then okay, yeah, sure, you probably understand it. Miguel, so to answer your question, they will profit from the change in the bond price. That's how they will profit. So bond traders, what they will be looking for is for that bond to remain to retract back to its face value, right? That's how they will trade that bond. Or if the bond is going to be trading at a premium and the interest rate is going to start to go up, then that value is going to go at a discount, right? So they'll trade that value down into a discount towards or ahead of maturity. That's how they make money. So imagine you have that same criteria that you're talking about. You have a bond, $100, 5% interest rate, go down to 2%, and then the present value is $103. Well, that bond, if interest rates continue to rise, then the price of that bond will start to go down, right? So if the bond market starts to price in interest rates going higher, then they'll start to sell more of those bonds. People will start to short those bonds. People will, in other words, that bond will start trading at a discount at some point. That's how it works. And then at some point they will buy those bonds back and then hold them to maturity, which will also give them an additional capital gain yield. So I hope that answers your question. I know how they make money, just how is that sustainable? Do they buy in hundreds of millions of dollars? Of course! I just told you that the bond market is the biggest market in the world. It's, as I was mentioning, the bond market is huge. People buy in like huge sums of money. It's not just a small amount of money. Look, it's $52.9 trillion as compared to the equity markets, which is only $40 trillion. There's a lot of money in bonds. A lot of it. So they invest a lot of money at a time. This is people who don't have the use for that money in the short run, right? Think about a business like Apple. Listen, like Miguel, think about it really simply, right? You don't need to complicate it. Apple has a lot of cash on hand, right? Apple has a lot of cash on hand. And if Apple has a lot of cash on hand, what does it do with the money on hand? It's going to put it in short-term investments, right? So, for example, Apple might invest in a revolving basis based on risk management. It might do 3-month bonds or 6-month bonds, and every time those yields expire, they will invest in a new tranche, and a new tranche, and a new tranche, and the yields keep getting higher and higher, they get more and more return on their bonds, right? So if Apple has $100 billion worth of money that is sitting around, they could benefit from that. Put it in short-term investments, right? That's an example. Okay, I see. So your average Joe trading with $100,000 can't really be a can't be a bond trader because the yield it returns based on interest rates isn't that much. I mean, you can if that's your risk tolerance. It all depends on what your risk tolerance is. If if you have 100K and you are okay with making 3% per year, you can always invest in the 30-year bond, right? It'll pay you a 3% interest per year, right? And that interest will be broken down either semi-annually or annually, right? It all depends on your risk tolerance. What are you willing to accept? But if you're somebody who has a higher risk tolerance, then why wouldn't you just stick that $100,000 into the S&P 500 index and make a passive 8 to 10% after inflation over a 25-year period? All boils down to your risk tolerance, right? It's not about how much of money you have that dictates. It's about what's your risk tolerance. That's more important, in my opinion. Like for me, I have a very small allocation in bonds, like 10% of my portfolio is in bonds. All right, any more questions? Let's see. I'll take any final questions here before we end the webinar. It's been a good 2 hours. Went definitely a bit longer than expected, but hey, I hope that it was helpful and beneficial to you guys. If this webinar was helpful and beneficial to you, drop a comment and let me know how helpful and beneficial it was to you, if you learned something new today. And I truly do appreciate you guys tuning in, and we're going to be doing this every quarter, so I hope that you will be joining us every quarter for this webinar event. Look out for more of the webinars in the future. We'll be holding one in the end of June, in the end of Q2. And yeah, I look forward to seeing all of you. Remember, we have pre-market sessions every Monday, Wednesday, Friday, 30 minutes before the market opens. So I'll see the rest of the crew pre-market today as the market opens. And yes, we'll go through the technical analysis for SPX and NASDAQ and all the rest as usual. Then, I didn't do any technicals here because this was a macro-driven webinar, but we covered the technicals and a lot more during the pre-market sessions as well as opportunities. Not to mention the newsletter is also going to go out sometime in the next couple of hours, so look out for that as the market opens. And I hope to see you guys on the next one. Take care, peace, and I love you all. Thank you so much for attending. Make sure you smash the like button one last time as you head out. And I appreciate you guys so much. Thank you, and have a good day, guys.